over the next 5 years, I think gold is pretty well positioned to take advantage of a stagflation environment where, stocks aren't going straight up, and margin pressure is being felt by a lot of these companies, and that sovereigns are kind of realigning their portfolios a little bit more towards diversification and real assets. During economic growth periods, so rising PMI environments, let's call them, generally investors prefer to be in other assets like equities or riskier assets, and gold tends to do well compared to other risk assets in declining PMI environments, which is what we're in now. So as you point out, it's held up better than most equities have year to date, for example, and it's also held up better than long duration bonds, which have sold off pretty sharply. And so I think it's starting to do its job here in 2022 as a defensive store of value. And I think that there's probably going to be a sovereign bid in the years ahead, because I think that there's an increasing realization among sovereigns that holding the bulk of their reserves in another country's liabilities comes with more counterparty risk than they thought. And so I think that we're going to see basically probably a greater share of gold exposure in sovereigns. But I think right now the market's rather diluted, right? So for example, people can invest in gold, they can invest in silver, they can invest in Bitcoin, they can go into like all these other cryptos that they went into. And I think that a lot of that has to be cleared out. Over the next 5 years, I think gold is pretty well positioned to take advantage of a stagflation environment where, stocks aren't going straight up, and margin pressure is being felt by a lot of these companies, and that sovereigns are kind of realigning their portfolios a little bit more towards diversification and real assets. There are a handful of things that are good money. I would classify gold, silver, and Bitcoin in that. But I think the long tail, these other things that a lot of retail investors poured money into are malinvestments. And so I think that as that kind of melts away, investors go back to what actually has value. And so I do think this is an environment where you want to have, your income diversified or as steady as you can get it, your expenses well contained, at least your kind of ongoing mandatory expenses rather contained, so that you're flexible to deal with hits to your income. And I think, it's good. One way I described it is that supply chains are optimized for low inventory and just-in-time delivery, and so it's kind of up to the households in order to have a buffer. And so that doesn't mean you have to have like you have to be like a full prepper with like a bomb shelter. But I think it means that it's good to have a stockpile of things that you need on a regular basis, whether it be food, whether it be paper products and things like that, but certain medicines. I think it's useful for consumers to have a buffer of supplies for things going forward, especially in challenging economic environments. These things are crystal balls, right? We're trying to predict this, severity of a recession. I think is inherently hard, and I'm not going to sit here in like an armchair and say, this is going to be the third worst recession in X number of years, and something that specific.
Yeah.
But basically,
Nobody knows.
we look at the combination of there's really not a lot of new energy capex coming online. And supply chains might be eventually improving somewhat as China opens, but I think the energy side is still problematic. And so we have real world constraints about abundance, basically our ability to have more goods and services cheaply. And then on the other side of that, unemployment is one of the most lagging indicators. So all of the leading stuff happens first. We've already seen now nearly a year now of deceleration in terms of all those leading things. And we're just starting to see it show up in unemployment numbers, but from a very low base, right? So unemployment looks pretty good. And we're starting to see that slowly get a little worse, but from a pretty strong position. And so I think that as we look out, we'll see tighter financial conditions. Unprofitable companies will have trouble raising equity, right? So they're having trouble growing and hiring more people. Very indebted companies will have trouble raising debt, and they might have to lay people off and slow down operations. And so I think that, and then that spirals when you start to get layoffs, you get weaker consumer demand, and then you get poor company performance that can result in more layoffs. And so I think that things that are discretionary in particular face squeezing here, right? So their costs are going up, while consumer demand is also weakening. And so I think that can continue spiraling into A recession, there's all sorts of variables that are hard to predict 6 months, 12 months, 2 years in advance. And so that's why you can have a long-term outlook. Like I will say that I think inflation is going to be hot for the better part of this decade. That's a very long-term outlook. When you filter out most of the noise, that's the main signal, is that we're not bringing a lot of new supply online for natural resources, especially energy, but also more broadly downstream of that, other natural resources. And to some extent, that's how history goes. We have these kind of roughly 15-year commodity cycles. You mentioned Rick Rule. He has that good quote that bull markets are all the authors of bear markets, and bear markets are the authors of bull markets. Where during periods of high prices, that encourages a lot of new producers to come in. Investors want to give them capital, and then they produce a lot of new supply. They eventually overproduce, and there's some sort of demand destruction that occurs. Then you have this supply glut. And so, or prices collapse, and then nobody wants to put money into the space, and eventually demand keeps creeping up, and we work out that excess supply, and we get higher prices, and the cycle starts anew. So commodities, because you don't control the price of your own product, are inherently kind of a boom bust industry, and it's historically operated on roughly these kind of 15-year cycles. And so we had this period of oversupply, especially in oil. Basically, we tapped into new energy sources. Combination of cheap credit, the willingness by investors to keep funding companies that were drilling while being free cash flow negative in shale, and so we flooded the market with oil, despite it not being particularly profitable to do so. You also added ESG concerns, things like that. And then some large pools of capital are in the impression that we're not going to need those resources in 5 years. Which I think is way off. It's a normal commodity cycle, but then it's amplified by a few things, including how much debt is in the system, like I mentioned before. And so going through the next commodity bull market with this much debt in the system is inherently going to be inflationary, right? So basically, policymakers are going to have trouble reining in demand, and producers are going to have trouble ramping up new production. I think it's going to take time. And right now, the market still is looking at this as somewhat transitory. They're still pricing oil futures out 3-4 years way lower than current prices. I think until the market wakes up and sees that, sure, the latest wars are adding to this problem, but if they see that the underlying problem is deeper than that, the underlying problem is lack of investment, it wakes up and starts pricing future oils way higher and encourages a ton of new production to come online wherever they can. I think this is going to be a problem for a while, and I think we need a lot of solutions for this, because it's hard to have real growth without energy growth. And we do live in a finite planet, and we do have, some finite resources. And I think it's going to take a lot of ingenuity to bring a lot of new energy online over time.